Welcome to the Salty Investors episode number 45. It's Friday, August 25th, 2023. Beautiful sunny day where I am, Tim. How about you?
Oh, same up here. It's looking great. So,
Yeah,
yep, all good.
God's country. Yep.
Yeah.
All right. Well, let's rain on that parade. What have you got for us for Salt this week?
Jim Chalmers says the nation's 3.5 trillion retirement savings pool needs a bigger role in defence and national security. My question, my question is, why stop at defence? The intergenerational report shows that climate change will cost Australia 423 billion over 40 years.
Whoa.
If we can match super and to solve climate change and move it as a great investment, everybody wins. But seriously, I think this should be a warning shot to all that super isn't safe from compensation. And, for the greater good, we need to act accordingly. What do you think?
Mm-hmm. Yep. It always bothers me when the government is trying to tell us where we should put our savings. I mean, they can't do most things properly. So why would they be able to tell us where we need to put our savings? Yes, put our savings in defence. Firstly, what do we mean when we talk about savings? Because I didn't think we had any savings. So he's talking about our savings, as in our massive superannuation savings of us.
Yep.
And he shouldn't be anywhere near that. Remember, he did this before. Remember, he came out and said he talked about. I think at that time he was talking about renewable energy. That's where we should be putting our money. But he shouldn't be telling anyone where to put money. I mean, Chalmers has no idea what he's talking about. Leave it to professional money managers and individuals to decide where to put your money. Well, government stay out of it.
But Scott, those submarines aren't cheap, or those F-35s. They cost billions. Who's going to pay for all that? I thought Gina Reinhart was going to pay for it all.
What's the return on invested capital in that, though? Tell me that for investors.
Oh, terrible. Yeah. Well, it's just going to be IOUs. That's all you'll be buying. IOUs from the government, and we'll just print more money to pay for it later.
Yeah, what is it? So they'll float a bond, and you get you get paid 6%. And as you say, it'll just be paid off later, which will be paid off with a deflated currency, which screws you over anyway. So the 6% that you earned on it's actually worth none.
Yep.
Yeah.
But it's this big honeypot sitting there waiting, just waiting for somebody to grab their hands on there. Like, you reckon the future fund was bad? This thing is just like sitting there, But if it helps investors, this is how they sell it. It helps investors, helps the climate, helps you. What's the loss? What's the downside here?
Well, you just said, I think you said that climate change was going to cost us 423 billion over 40 years. So is that what's going to cost us if we don't do anything, or is that what's going to cost us to address it?
No, I think that's what it's going to cost the economy. So
to address climate change, to get to net zero and all that sort of stuff.
I think that's the damage it's going to cause. So
that's the damage. But see, like 400 billion over 40 years, that's like 10 billion a year. That's nothing. So that's why, and we're spending way more than that to address it, to ameliorate $400 billion worth of damage. I mean, the numbers just don't add up. Doesn't matter any way you slice it.
Yeah. Well, they seem to love it, there's narrative, and, if you add a few wars in there, like, you can imagine if, they decide they really wanted to take on Russia, they can't even handle it, now. Like, all the shells and all the armaments will have just totally depleted from UK and US. That's why they send cluster munitions to the Ukraine, because they had nothing more to send. Like, it's just, there's nothing left in the tank here. Like, they can't afford a war, and, Well,
maybe Chalmers means by investing in defence that we invest in weapons makers. Maybe that's not a bad return.
Yeah, that's what he does.
Oh, right.
But
so he's talking about what, in investing in Northrop or what? What are we talking about?
No. It's got to be onshore, Scott.
Yeah. We're going to make
people
it.
In South Australia making these things.
Yeah, even though we've got absolutely no expertise in making such things.
And you can imagine how, like, the submarines were bad. Imagine what the freaking missile defense system's going to be like. Like.
Get the unions in there, make it cost twice as much.
Yeah. Yeah. Looking forward to things to happen. So, but yeah, I can see gold, and if you own gold or Bitcoin, you're not sort of worried about all these things. These Neanderthal assets might come back into vogue. You keep talking this crap up. So,
Yep. Well, gold is the laggard when you look at commodities.
Yep.
All right. Let's get on to some macro stuff. Not a lot to talk about this week, I don't think, or maybe I'm just lazy this week. I just thought this was interesting. This is a flash PMI, so it's sort of it's the unofficial PMI, Purchasing Managers Index for Australia. Yeah, so it's gone into negative territory. See, the last time it did that in late 2021. There's a organisation in Australia called the Australian Institute of Supply Management, or something like that. They put out official reports. Their one won't be out yet, but it's been negative for quite a while. And so what it suggests is that in aggregate, the manufacturing sector is in decline, is contracting, I should say, in Australia. So that's just an interesting one to watch. Maybe all those electricity costs catching up with us, inflation.
Yeah. Yep. Well, it hasn't gone too negative, so hopefully not too bad.
No, it's not. Yeah. No, you see I'm scraping the bottom of the barrel for data this week. So this was from Macro Business. We've put up this chart before, but it's actually gone negative year over year now. Before we just had a chart up showing it was sort of receding, but now it's negative year over year. And again, you have to go back to the financial crisis when bank credit went negative year over year. And look at that. I mean, this chart goes all the way back to 86. So it's unfortunate we don't have the 70s there, because that would be interesting, or even the early 80s where you had a pretty nasty recession. But you can see, even in the 90s recession, which was fairly shallow in the US, to be honest, it never got less than 2% year over year, and even dot-com bust. So it's only the financial crisis where you had a real drain of liquidity, and now it's gone negative once again. So we didn't even get negative in 2020 for bank credit, because obviously the spigots were turned on.
Yep.
But of course, all of this is just academic, because in about 15 hours, Powell is going to say something at Jackson Hole and change the world.
Yep.
That's markets typically want to focus on these minutiae.
Yeah, he's got the dials there. Powell will turn one up, turn one down, and get it all on track somehow. So.
Yeah, so I just thought that it's worth reiterating the point that it's hard to see markets and economies doing particularly well when the lifeblood of the economy, which is credit, is in contraction. And I think that's all I got this week. This was from Eric Cinnamond of Palm Valley Capital, because he's done this really good job of documenting a lot of the companies that he looks at, and he sort of looks at US small caps a lot, and he's looking at restaurant chains and other he's looking at a whole range of industries. But what he's continually finding is that the high-end consumer is doing absolutely fine.
Yes.
The low-end consumer, like in a lot of cases with restaurants, it's just not showing up anymore, but the high-end consumer is showing up and paying higher prices. So you've got cases where the company's profits are actually going up, their sales are going up, even though they've got less customers coming through the door, because the high-end customer is spending more than they used to, and that's making up for the lack of low-end customers. And so this is sort of reflecting that here. I mean, look at the Wilshire 5000, which is, as you were saying earlier before we started this, that this is hardly, this is not just, the top 10 tech stocks or something. This is a very, very broad index. And as against wages and salaries, which haven't done much at all. So the people that own the people that are the owners of capital and stocks and other investments are economy one, and all the rest our economy too. And I mean, I'm not a big I don't get overexcited about income inequality, because people often forget about income mobility, that people do move up out of groups. But you don't want to, your society is not going to be better if you have this bifurcation against people living in, gated communities with security guards and everybody else who's, that's not the type of society you want. And
just interest rates, I know they hurt the first economy, but crikey, they still employ the second economy, and I don't know, it's just not a very nice way when you got such a divergence of people. That's all. It's not very stable.
Yeah. No, it's the pitchforks come out.
Yeah.
But if the stock market deflates and like from here 30 or 40%, then that economy number one will start to feel the heat as well.
Yep.
All right, so let's get into this week's stock that you brought us. It's the OTC.
Well, OTCs is the old pink sheets, if you remember, pre-2008. It's a rare small cap that I can look 10 years into the future and be fairly certain it will be intact. The moat will be intact. The moat is fairly strong as it's reinforced by FINRA and the SEC. Customers are on subscription and licenses with low churn rates. Currently, it operates in regulated markets for trading 12,000 US and international securities. There are three segments which make up revenue. That's OTC Link, which is a FINRA broker-dealer, which provides regulation, messaging, trade execution over OTC. Market data licensing, which I've always downplayed. I didn't think the market data was that valuable, but it takes up a third of revenue. And corporate services, what everybody basically knows, the pink sheets, public trading without the cost of listing on a centralized exchange.
Yep.
We look at the fundamentals. The shares outstanding are going in the right directions. They have got stock-based comp, but they're buying back more. Yep. Employees is growing, from the 80s to 130 people now, but it's in line with revenue. Price to fee cash flow is fairly high on a historical basis, but it gives plenty of opportunities at lower rates.
Yep.
You look at them. Return on invested capital and margins are phenomenal. Great payout ratio and no debt. If we flip over to the balance sheet, we can see that, negative net debt and cash flow was slowed in the last couple of years, but it's much higher than what it was in 2019, which I like to see. Yep. Flip over to the multiples. You can see that it's, currently a little bit high, but, you've got to pay up for quality. I've written a bear case. There's limited areas for it to reinvest. It's a takeover target, so you could, lose your stock. It's too small for most funds to invest. The regulation framework could change. Bull case, it's quality. Capital light. It's been in business since 1904. There's growth in overseas markets. It's a takeover target. Provides an essential services for businesses that want to access capital markets but don't want the hassle, time, cost, or don't meet the regulation requirements to list on a centralized exchange. I'd love to find more of these small caps with brilliant moats, but they're nearly impossible for me to see. What do you think?
So the moat is that they are the first mover. There's no one else really doing this. And the regulatory requirements and compliance must be huge for these guys. And to start up this similar sort of business here would be extremely time consuming and a lot of money and a real pain in the ass.
And FINRA and the SEC would fight you because they like dealing with this company. 1904. Look, got a bit of a track record here. You don't want to be switching, and there's a lot of scams in in the pink slips. Like there's like
Yep.
pink sheets is like scammy companies with scammy balance sheets. You know, there's all fraud everywhere. But
Yep.
you need someone at the top who's sort of, you know, who's saying, we're not
Well,
fully
what's their
regulated, but yeah.
are they on the hook here if
No,
there's a scam and no, they're
no.
not. Okay.
But it's all regulated by under the SEC. So
Right. Okay.
like you get all
Yeah.
these dodgy people putting in dodgy balance sheets. You know, like it's a wild west in here. Like
So
if you're
they're
in the
just
pink
like,
sheets, you're not
hey,
like
it's
retail.
not. Yeah. 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 Yeah.
There's no way that me or you are in here like trading pink sheets. Like it's
Mm.
proper freaking Wall Street guys here, and that's where they make a lot of
Mm.
money. They charge them, 15 grand a year to access or whatever, or 80 grand a year just to access the market and trade. You need a broker to trade, and it's like very old school. Like this isn't going to change. And but if you're a little oil explorer or oil royalty company, or you're a small cap that supposedly went up and got listed on the NASDAQ or something like that, and then everything fell apart, and your
Mm.
employees have still got a whole heap of shares, this is an option. You could still roll back into this
Yeah.
and list on OTC. So it's got multiple uses and benefits for society that people can still access capital and liquidate their positions. You see it in Australia now where they're trying to, do all this stuff in little isolated areas. Like those little,
Mm.
we've got a little beer company and we'll try and raise capital and,
Yeah, well, you have those platforms. You mean like Equitize
yes,
or something like that? Yeah, the crowd essentially is sort of a crowdfunding for non-sophisticateds. Yeah,
yeah, but
yeah,
the problem with that is it's just there's no liquidity pool. It's just
yeah.
they're all fragmented across,
It's all retail. Yeah,
yep, and it's all retail, and there's no way institutions or family offices can come into that stuff. It'd be very hard
yeah,
for them to. They'd be worried about the platform. But if you've got something that's been going since, early last century,
yeah,
you're pretty confident these guys are going to be around. The Lindy effect. That's what I love it. But you
yeah,
just look at those return on invested capital numbers. Like,
yeah. It's ridiculous.
what are we doing? Mucking around with some of this other stuff. Buffett would. Buffett and all these other fund managers would buy this stuff. You just look how small this thing is. It's just tiny,
Yeah.
tiny. There's $100 million worth of assets or something. Like it's just nothing. This is. But
Is this tightly held? Because the number of shareholders has been constant for
yeah,
7 years.
yeah. So basically, they do. If you work in the place, obviously you get paid very well. Well, there's only 130 people working there.
Oh, is that's not a God? Because usually, it says like 1,000. I thought, it must be 130,000. But that's literally 131 people.
I think so. I'm not sure exactly, but I think
Right.
they've got a lot of people working there. But they're all. I think they're the in-house people. Like, obviously
Right.
there's heaps of other people that'd be linked in, but they get stock-based comp. That's how they sort of. And if you worked in this place, holy hell, it's a great stock to hold. You imagine you're getting a whole heap of stock-based comp on this. Look at it. Just where do you see 50s and 70s in your return on invested capital? Like, come on. Like,
I know.
what,
Yeah.
what are we
It's
doing?
crazy.
What are we doing mucking around with stuff with 2s and 3s? Like, what are you doing? Like, this is better than MasterCard and Visa. It just hasn't got the growth potential. That's the thing that's hammered.
Yeah.
But this would work well in Australia.
Yeah.
Why don't we have this in the UK?
Too small. Australia, they don't care.
Yeah. But I'm
We're a
just saying.
pissant,
Yeah. But heaps of small miners in Australia that really shouldn't be listed on the ASX. They're too dodgy.
Yeah.
There's no way that retail should be investing in a heap of this junk. And a lot of it, I'm sure, is fraud. Like I'm sure. Well, I just see a lot of reports and I just can't understand it. I'm like, what are you hiding?
Yeah, some guy brought an acre somewhere, and he's, I stuck a ruler in the ground. This is my assay.
Yeah.
We detected some copper. There we go.
And there's no analysts that are really following it to pressure these guys, to say, what are you doing? Is it real? And the ASX can't keep up. They're just hopeless. And the regulators are even worse. They just got no chance of holding it back. But yeah. So I think that's why this is quite valuable, because it's only institutional and sophisticated investors, play in this area.
Yep.
And that's why I like it. Like, if you get burnt and you're in that area, well, like, nobody's going to shed a tear for you, I'm afraid.
Yeah, no. No blaming the short sellers.
No. So yeah, I just thought you'd like this one. Normally I'm doing.
I do.
Big caps, and
this is going on the watch list.
Yeah, and so this made it into tier 2 for me. So this is how much I love it.
Right.
So that's in with my staples like Nestle and like FICO. All these huge names, and you've got this micro company which I can't see any. Throw rocks at it if you like, but
yeah,
I'd love to hold.
I suppose that's the only thing, isn't it? Where's the growth come from?
Yep.
Yeah. So I guess that was my question. This does better in cycles when M&A is high. So this would have done good in 21, maybe.
Oh, 20, yeah. 21 and 22. This is thing on fire, like, because you got all these people that want to list and all this crap. Yeah. But they don't have to get on the New York Stock Exchange is bloody hard now. Like, you need to be really doing some numbers. And this is a great stepping stone. People should be doing this first before they list on the New York Stock Exchange. That's right. I reckon you should. You shouldn't be going straight to the New York Stock Exchange. You should be going on the pink sheets and then prove yourself a little bit, and also gives liquidity to some of your shareholders, and if they want to exit or whatever. So,
no, it is good because I full disclosure, I invested in a company on Equitize here in Australia, and that company, they've done 2 rounds, and their plan is to list next year, because they've executed. As far as I know, we haven't had a report in about 6 months or so, but yeah. And that's the way they did it. Yeah.
And that's best to take it one step at a time. And this is a great stepping stone. So I think they will survive. And I wish they would be more aggressive. And they have bought a few
they're just
data companies,
fat and happy. They're just fat and happy. Just sitting there, creaming these returns in, collecting.
If I own
paychecks and stock options,
this would be the business that I would own. Like, just capital light, low number of employees. You got a moat behind you. You'd be handing this down to your great grandchildren. This thing's gonna probably stick around. Prints cash. So.
All right. Well, there you have it, folks. OTCM, OTC Markets Group. Tim's done it again. And we'll see you next week. Thanks a lot.